Did you know that Australia now has one of the highest household debt levels in the world? Or that over 880,000 Aussie mortgages are set to expire by mid-2025, possibly triggering a wave of financial stress we've never seen before? The media keeps talking about property booming, but behind the scenes, the cracks are starting to show. Homeowners are struggling, interest rates have skyrocketed, and buyers are beginning to disappear from the market. Could this be the beginning of Australia's silent housing crash? Experts are warning that millions of Aussies could be at risk by 2026, and no one's talking about it. In this video, we're exposing the 10 biggest reasons why the property market might be heading for a serious fall and what it means for you. Before you buy, sell, or invest, you need to hear this. Stick around because this could affect your future more than you think. Number 1. Record high household debt. Let's start with something that should raise every eyebrow. Australians owe more money than almost anyone else on Earth. As of 2025, the average household debt-to-income ratio in Australia is sitting at a staggering 188%. That means for every $1 a household earns, they owe nearly $2. Let that sink in. For years, rising home prices made people feel safe. Borrowing big didn't seem risky because property always goes up, right? But here's the problem. When debt levels are this high, even a small rise in interest rates or living costs can trigger massive financial pressure. And that's exactly what's happening right now. Interest rates have surged, grocery prices are up, energy bills are hitting new highs, and suddenly thousands of households are finding it hard to breathe. People are dipping into savings, delaying bills, or just barely hanging on to their mortgage payments. But what happens when there's a job loss, or a medical emergency, or another rate hike? With this much debt in the system, the risk is not just personal, it's systemic. Economists warn that widespread mortgage stress could lead to forced sales, price drops, and even a domino effect across the housing market. And remember, this isn't just a low-income issue. Middle and high-income families are feeling it too. So when you hear someone say Australia's housing market is strong, ask yourself, strong for who? Because beneath the surface, this mountain of debt is starting to wobble, and if it topples, millions could be caught in the collapse. Number 2. Interest rate shock. Remember when mortgage rates were below 2%? It felt like free money. Banks were practically begging people to borrow, and Aussies jumped in, buying homes, upgrading properties, and taking on massive loans. But then came the interest rate shock. Since 2022, the Reserve Bank of Australia has raised interest rates over a dozen times, pushing the official cash rate from historic lows to levels not seen in over a decade, and it happened fast. For many borrowers, this meant their mortgage repayments doubled, almost overnight. Imagine going from paying $2,000 a month to nearly $4,000. No warning, no extra income, just a brutal increase, and no way to avoid it. And here's the twist. Most people weren't ready. They budgeted for low rates, not this. And now families are cutting back on essentials, falling behind on payments, and facing serious mortgage stress. But it's not just a few unlucky households. According to recent data, 1 in 4 borrowers is now experiencing repayment stress, and that number is still rising. Why does this matter? Because when too many people can't afford their homes, the market reacts. Distressed sales increase, prices start to slide, confidence vanishes. It's a vicious cycle, and we may already be in the early stages. The big question isn't if interest rates have caused damage. The question is how deep the cracks go and whether the system can hold under the pressure. The rate shock wasn't just a tap on the brakes, it was a full-blown slam on the brakes at 100 kilometers an hour, and now the housing market is bracing for impact. We work hard to bring you the truth behind the headlines, so if this video made you think, drop a comment and tell us your take on the future of housing. And don't forget to subscribe with just one click. It's free for you, but it helps us keep creating content that matters.
Number 3. Expiring fixed-rate loans. Australia is heading straight for what experts are calling the mortgage cliff, and it could be one of the biggest financial shocks in recent memory. Here's what that means. During the pandemic, hundreds of thousands of Australians locked in ultra-low fixed-rate home loans, some as low as 1.9%. At the time, it seemed like a smart move, and it was, temporarily. But now, those fixed terms are ending, and borrowers are being thrown into a completely different reality. They're coming off record low rates and suddenly facing variable rates of 6% or more. In real terms, that can mean an extra $1,200 to $2,000 per month in mortgage repayments, with no real increase in wages to soften the blow. According to the RBA, around 880,000 fixed-rate loans are due to reset between now and mid-2025. That's not a small wave, it's a tsunami. And for many families, this sudden jump in repayments is unsustainable. They're already maxed out. There's no buffer left. What happens next? Some will be forced to sell. Others may default. And once these distressed properties hit the market, they could drag down home values in entire suburbs. Even renters won't be safe because desperate landlords may increase rent to cover their higher loan costs, pushing rental prices even higher. The mortgage cliff isn't just a finance term, it's a real-life trap that's already catching families off guard. And once enough people fall, the whole market could start to slide. This is one of the clearest warning signs that a silent crash might already be unfolding, right under our noses.
Number 4. Housing supply glut in key suburbs. Everyone talks about Australia having a housing shortage, and in many places that's true. But in certain areas, the opposite problem is quietly unfolding. Too much supply. That's right. In some suburbs, particularly inner-city zones and high-density developments, we're seeing a glut of apartments flooding the market. Driven by years of aggressive construction, especially in cities like Melbourne, Sydney, and Brisbane, thousands of new units have hit the market, many of them identical high-rise apartments that investors rushed to build during the boom. Now there's a problem. There just aren't enough buyers or renters to fill them. Vacancy rates in these pockets are rising, rental prices are stagnating, and property values are starting to slip. It's basic economics: too much supply, not enough demand. And it gets worse. Many of these apartments have low resale appeal thanks to poor design, limited space, or defects that have surfaced post-construction. So not only are they hard to rent, they're hard to sell. Some investors are already trying to offload their properties at a loss. Others are hanging on, hoping the market will bounce back. But what if it doesn't? When enough properties sit vacant or sell below value, it can drag down prices in entire suburbs. And if confidence drops, more investors will rush to exit, flooding the market even further. So, while the national narrative is focused on a housing shortage, don't be fooled. In certain areas, especially overbuilt suburbs, oversupply could be the silent killer of property values in the years ahead. This is the part of the crash that nobody is watching, but everyone should be.
Number 5. Declining immigration growth. For decades, immigration has been the secret fuel behind Australia's booming housing market. More people equals more demand for housing. It's simple economics. And for years, that formula helped keep prices high, especially in cities like Sydney, Melbourne, and Perth, where new arrivals needed somewhere to live fast. But now, that growth engine is starting to slow down. After the post-COVID immigration surge, projections from the federal government show net migration is set to drop sharply between 2025 and 2026. Stricter visa policies, rising living costs, and global economic uncertainty are all contributing to the shift. And here's where it gets serious. Less migration means less demand, especially for rentals and entry-level homes. That's bad news for investors who banked on strong population growth to support rental yields. It's also bad news for developers who built new housing projects assuming constant demand. In fact, some inner-city units that once rented within days are now sitting vacant for weeks or months, even with price drops. If fewer people are entering the country and more people are leaving expensive cities for cheaper regional areas, the pressure on urban housing markets could collapse from underneath. This doesn't mean demand disappears overnight, but it does mean the foundation that supported high prices for years is starting to crack. And without steady immigration to prop it up, the housing market might not have enough strength to hold its ground, especially with all the other pressures we've already discussed. This is a slow burn risk, one that could quietly reshape the property market over the next few years. And by the time most people notice, it might already be too late.
Number 6. Wage growth isn't keeping up. Let's face it. Everything is getting more expensive, but your paycheck probably isn't growing fast enough to keep up. In Australia, property prices have skyrocketed over the past decade, but wage growth has been painfully slow. According to recent figures, wages have only increased around 2 to 3% per year, while housing costs, both buying and renting, have surged far more. This growing gap has created a major affordability crisis. Take a moment to consider this. In the 1990s, the average house cost around 3 to 4 times the average salary. Today, it's more like 8 to 10 times, and even higher in major cities like Sydney and Melbourne. That means the average Australian now has to save longer, borrow more, and sacrifice more just to get into the market. And for many younger Aussies, home ownership has become a distant dream. The problem is, when people can't afford to buy, demand weakens, and when demand weakens, prices start to fall, or at least stop growing. So while some sellers are still clinging to high price expectations, buyers simply can't afford them anymore. This mismatch between income and property prices is like a pressure cooker, and eventually something has to give. Even landlords are feeling it. With borrowing costs rising and rental income capped by what people can actually pay, many investments no longer make sense financially. In short, a housing market built on the belief that prices can rise forever doesn't work when real incomes are falling behind. If wages can't catch up, and fast, the entire system starts to break down. And right now, we're seeing the first signs of that breakdown. Number 7. Rental market strain. You've probably heard it. Rents are going through the roof. And it's true. In many cities, renters are facing record-breaking increases, being forced to compete for tiny units or even move further out just to survive. But here's the twist. Landlords are struggling too. Why? Because while rental prices are rising, so are interest rates, council rates, insurance premiums, and maintenance costs. The return on investment, once considered a sure bet, is now looking a lot more uncertain. For many landlords, especially those with multiple properties or big mortgages, the numbers just don't stack up anymore. Some are being forced to sell up, especially if they can't pass on the rising costs to tenants due to rent caps or affordability limits. Others are increasing rents aggressively, pushing more tenants into financial stress. The result? A highly volatile rental market that's failing both sides. For tenants, the pressure is real. Families are downsizing, young adults are delaying moving out, and homelessness is rising in some areas. For landlords, uncertainty is growing. Negative cash flow, loan defaults, and stricter lending criteria are all creating a ticking time bomb. And here's where it connects to the bigger picture. If landlords continue to exit the market en masse, we could see a spike in forced sales,
leading to an oversupply of investment properties, especially units, and downward pressure on prices. At the same time, renters face a shrinking pool of available homes. It's a lose-lose scenario, and one that could destabilize both the housing and rental markets if left unchecked. This isn't just a rental crisis, it's a structural breakdown, and we're only beginning to see the fallout. Number 8. Overseas buyer restrictions. For years, foreign investors, especially from China, Singapore, and the Middle East, flooded into the Australian property market, pouring billions into off-plan apartments, luxury homes, and prime city real estate. In fact, in peak years, overseas buyers made up more than 10% of all property transactions in key areas like Sydney and Melbourne. But that flood, it's now a trickle. Why? Because the rules have changed, and so has the global outlook. The Australian government has introduced stricter foreign investment rules, including higher taxes, surcharges, and tighter approval processes. Add to that global economic instability, currency shifts, and rising interest rates, and you've got a perfect storm pushing foreign investors away. In 2024 alone, foreign buyer interest dropped by nearly 40% compared to just a few years ago. That's a huge hole in demand, especially for the high-end market and inner-city units, where overseas buyers once dominated. Developers who relied on foreign pre-sales are now struggling to fill buildings. Investors looking to flip to international buyers are stuck, and suburbs once propped up by overseas demand are now softening fast. But it's not just a luxury end that's impacted. With less foreign capital flowing into the market, there's less overall competition, less upward pressure on prices, and more vulnerability to local economic shocks. For years, foreign money helped insulate Australia's market from downturns. Now that safety net is disappearing. And if local demand continues to weaken while global buyers stay away, we may see price corrections in areas that were once considered untouchable. This isn't just a policy shift, it's a massive structural change, and the effects are already starting to show.
Number 9. Affordability crisis and buyer fatigue. Let's talk about something that's not always in the stats, but is felt across the country. Buyer fatigue. After years of price surges, intense competition, and constant media hype about getting in before it's too late, many Aussies are simply burnt out. They're emotionally drained, financially stretched, and no longer willing to chase the property dream. And who can blame them? In major cities, the average house price is over 10 times the average annual income. That's not just expensive, that's unattainable for millions. Young Australians are being forced to delay home ownership, live with parents longer, or settle for far less than they hoped. Even double-income families are struggling to save enough for a deposit while juggling skyrocketing rents and everyday expenses. The result? First home buyer activity is dropping and investor interest is cooling too. That's a dangerous combination, because when buyers leave the market, sellers are left with fewer options. Listings sit longer, price expectations fall, and suddenly that safe investment starts to look a lot riskier. And here's the kicker. This isn't just about today. This is a long-term trend. If an entire generation feels locked out of the market, demand could stay suppressed for years, not months. That kind of sustained slowdown puts serious downward pressure on prices, especially in outer suburbs and fringe developments where demand is most fragile. So while the headlines still focus on how high prices might go, the truth on the ground is different. People are exhausted, they're priced out, and they're walking away. That's not just buyer fatigue, it's a market turning point, and it's already underway.
Number 10. Global economic uncertainty. Even if you think Australia's property market is unique, we don't live in a bubble, and what's happening across the world could hit our shores harder than most people expect. Right now, the global economy is on shaky ground. China, Australia's biggest trading partner, is facing a major real estate crisis of its own, with entire cities of empty apartments and major developers collapsing. Europe is battling inflation and energy instability, and the U.S. is on edge with interest rate hikes, tech layoffs, and a cooling stock market. When the world sneezes, Australia catches a cold. If global demand drops, our exports slow. That means less income, job losses in key sectors, and a squeeze on household spending, right when Aussies are already stretched thin by rising mortgage repayments. And if international investors lose confidence in Australia's safe haven status, we could see capital flight, with foreign funds pulling out of property, businesses, and banks. This uncertainty has a chilling effect. People hesitate, they don't buy, they wait. And in a market that relies heavily on confidence and momentum, that pause can be devastating. We've already seen global shocks shake our markets before. Think of the GFC in 2008 or the COVID crash in 2020. The question is, what happens if we face another shock now, while household debt is at record highs, interest rates are painful, and buyer confidence is already fading? The answer? A perfect storm. Global instability isn't just a headline, it's a real threat to Australia's property market. And when combined with the 9 other reasons we've covered, it's easy to see why millions could be at risk by 2026. So, is Australia really heading for a housing crash? When you look at these 10 warning signs, crippling debt, rising rates, buyer fatigue, oversupply, and global uncertainty, it's hard to ignore the pattern. This isn't fear-mongering. It's a quiet crisis that's already unfolding in slow motion. The headlines may still say record highs, but the foundations are starting to crack. And by 2026, millions of Australians, homeowners, investors, and renters could find themselves in a very different reality. The truth? This isn't just about property. It's about the financial future of a generation. That's why now, not later, is the time to prepare, act smart, and understand the risks. Because the ones who come out on top won't be the luckiest, they'll be the best informed. While the outlook may seem uncertain, you're not powerless. The key is preparation, not panic. Here's what you can do. Review your finances. Understand your mortgage terms. If you're on a fixed rate about to expire, start planning now. Speak with your lender or a mortgage broker to explore refinancing options or rate negotiations. Build a safety buffer. Aim to have 3 to 6 months of expenses saved. With rising costs and economic shifts, a cash buffer can be your lifeline. Diversify your assets. Don't put all your wealth into property. Consider other investments like index funds, superannuation, or even upskilling to increase income potential. Research before you buy. Not all suburbs are created equal. Avoid overbuilt, overpriced areas. Focus on long-term fundamentals like employment growth, infrastructure, and population trends. Stay informed. Markets shift. Stay updated with real data, not just headlines. Knowledge is your best defense. Remember, every downturn brings opportunity for those who are ready. If this video opened your eyes, let us know in the comments. Do you think a housing crash is coming, or is it all hype? We pour hours into research to bring you content the mainstream won't. So if you found value, support us with a like and hit that subscribe button. It's just one click, but it means the world to us. And before you go, watch our previous video for more surprising insights that could protect your finances in the years ahead. Thanks for watching. Stay smart, stay informed.